The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Welcome to another episode of JMF Advisors Podcast. Today we will be discussing the Federal Employee Retention Tax Credit. I'm Carl Jamison, and joining me in studio is Kristi Moore, who is a shareholder at JMF and is the co-manager of our Client Accounting Services Department and works on ERCs for all of our clients. She's kind of our go-to person there. And then we have via Zoom Shannon Scott, who's the CEO of OnCentive, a specialty business incentive firm based out of Birmingham, Alabama. And we also have Mary Ann Moorman with us from OnCentive. Thank you all for being here with us today. A little bit about OnCentive. Their leadership has a lot of years of experience in employee tax credits, and we've worked with them off and on over the years and with their leadership in some other companies. And we just now started a relationship with OnCentive to help us with ERC credits. And we're looking forward to working with you, Scott,
Yes.
again.
We're excited for the
Shannon,
partnership
yeah.
and the benefits it can provide to our clients.
Absolutely. So we're excited about that. You know, the Employee Retention Tax Credit was first introduced in March of 2020 to incentivize employers to retain employees during the pandemic. And as part of the CARES Act, there was a credit set up that was for eligible wages from March 12th, 2020 to I think the end of December 2020 originally. Right?
I think that's right.
And it was a credit of 50% of $10,000 worth of annual wages in that first go-around.
That's right.
Then in December of, I think it was in December of 21,
Or 2020.
2020, they upped that. They extended the wage period through June of 21 and upped the credit to 70%, and I think it's of $10,000 per quarter per eligible employee.
That's right.
Something like that.
Yeah. And it continued to change after that, didn't it?
I think it has. So I told Shannon and Kristi. Kristi already knew it, but I told Shannon before we started that the person in this room knowing the least about ERCs is me. So I'm kind of going to turn it over to Kristi and Shannon and let them go over the ERC, how it works, when it expires, all those good things. So I don't know who's going to start it off.
I can kick it off.
Okay.
Yeah.
Yeah, absolutely.
As it stands today, the credit is for wages paid anytime, like Carl said, beginning in March, mid-March of 2020 through September of 2021. There's been some changes, We first had the fourth quarter, or I say first, but in one change, we had the fourth quarter of 2021, and then that was repealed. So as it stands today, like I said, there's about 6 quarters worth of wages that can be looked at, and there's a couple of different ways to qualify. Obviously, with most things tax related, it's complicated. So we'll be glad to help and put you in touch with the OnCentive folks in lots of situations. So the first way to qualify for the credit is by experiencing a decline in gross revenues.
Yeah.
And so for 2020, the test is if any quarter, 2020 compared to 2019, an employer experienced a decline of 50% or more, they will qualify for the credit. And that extends on in subsequent quarters until they reach a higher level. There's some different amounts for the test. So definitely we can look at those gross revenues in 2020 to see if an employer qualifies for that for the credit then. And then in 2021, when you compare the quarters of 2021, those first 3 quarters, that is, to the same quarter in 2019 still, if they experienced a decline of 20% or more, then they will qualify then. And there's a safe harbor where you can look at gross revenues in a prior quarter.
So
But
you're measuring back to 2019.
Yes, in
That's
each
your
year.
base period
That's
each
right.
year.
That's right.
And in 2020, it was a 50% decline, and in
Yes.
2021, it's a
It's a
20%
decline.
Okay.
That's right. Shannon, tell us a little bit about the other way that employers can qualify for the credit.
Yeah, so the gross receipts or gross revenues is obviously, like you said, one of the tests. The kind of more complex and complicated test is going to be in the disruption portion of the bill. These retention credits are not anything new. They usually typically follow a disaster or a hurricane as well, but they're typically income tax based and not payroll tax based, where these credits are. And in those types of credits, there are business disruption tests that you have to qualify for. And there's a lot of bad advice floating around, so we kind of try to make this as clear as possible. A lot of companies are under the impression that you have to have been affected by a local mandate. For example, let's say you have a business in Atlanta, and because of a local mandate in Atlanta, you either had to shut down your practice for a little while, or you had employees who had to social distance. So you had some employees working from home, some employees working from the office. If you're a retail business or a restaurant, a lot of cities, had mandates where they had to shut down early, which obviously could have caused revenue issues. But, some bars and restaurants were used to shutting down at midnight, 1 or 2 o'clock in the morning. They were forced to shut down at 8 or 9 o'clock at night. Plus, with the social distancing mandates, they weren't able to service as many customers as they normally would. Those kinds of tests are tests that we have to do research on and make sure that that mandate did affect their business in one of those ways. It could be even something as crazy as you had to take extra sanitation practices and spend extra money on bringing in sanitation crews and cleaning crews and things like that for your restaurant or retail. Where things really get complex is especially when you're looking at supply chain issues.
Yep.
A lot of advice has been given to customers where they're told, again, that only the local mandate can affect you, and that's not necessarily true. For example, a lot of the ports in the country were mandated to have vaccination requirements, which means they were running at 20 or 30, 40% capacity from an employee perspective. So if you're a grocery store in Atlanta and you get your paper towels or your produce from California, but the port of LA was closed down because of mandates, that affected your business in Atlanta. So that is a qualifying factor as well. So we really have to dig, and we have to look at the supply chain, where you're getting your product from, where you're getting your even if you couldn't rent equipment at that time. Let's say you're in the construction industry and you couldn't get equipment or rent equipment. Those things are things that would be considered business disruption. And so it's a little bit more complicated test, but we're going to follow the social mandates and the laws that the bill clearly states. And again, like you said, there's been different iterations of the bill too,
Sure.
and that can also get complicated. It was changed 3 different times, which is Congress loves to do that, right?
That's
so
right.
we've got to follow those as well.
That's right.
And the regulators certainly like to put their 2 cents in on what they think the legislature meant to say in the bill.
That's right.
So, Kristi, we do a lot of the revenue tests. We've done a lot of credits. We continue to look at clients to see if they qualify strictly under the revenue test. But as Shannon was mentioning, that harder test, the mandates or supply chains, that's where we bring them on board, because we're just not set up
That's right.
to make those calculations and those assessments where
That's right.
Shannon's team
And
is.
like Marianne and I have spoken about, medical practices as a place where there's a good bit of opportunity in your guys' experience for the interruption qualifier. So we're definitely planning to look at several of those.
Yeah,
Right,
I think
absolutely.
Go ahead,
Go ahead.
Shannon.
I was going to say the medical offices, you wouldn't normally think that they were so affected because a lot of people were coming in trying to get treated for COVID. But what you ended up having was you had the social mandates for distancing. And then a lot of medical practices had to shut down voluntary surgeries and elective surgeries during that time as well, which obviously affected them. And, they were sending a lot of employees just at home because they couldn't, these nurses and these doctors weren't able to perform these procedures.
Yeah, now, dentist office seemed like they were mandated to.
Yeah, they had a
Close
period
during
where they
that
were
period,
mandated
weren't
to
they?
close, and then I think once they opened, they were kind of under similar requirements where there were certain procedures they could perform and not.
Yeah, so
Yeah, and that was directed by the American Dental Association, right? Had come out and set a lot of those mandates. So it wasn't necessarily just a local mandate that affected them, but the American Dental Association, which is a government-funded organization, came out and said, hey, you have to restrict these types of procedures and things. And so that would be considered a qualifying factor.
And I think Shannon mentioned a minute ago, but I wanted to clarify. So this credit is not an income tax credit. This credit, if you qualify, is a credit against your employment taxes, your
That's
941 taxes, and that's how you'd get the refund, right?
That's correct.
Yeah.
So the credit is filed at this point on a 941X, which is an amended payroll tax form. And we do still have some time to get those filed. For the 2020 credits, we have until January 2024. And correct me if I'm wrong, Shannon. And then for the 2021 credits, we have it until January 2025. So we've still got some time to continue these assessments and make calculations. The credit amount for 2020, like we've talked about, there's differences between the 2 years. And so the credit amount for 2020 is based on $10,000 worth of wages per qualifying employee for the year. And the credit amount was 50% of those wages. So per employee, $10,000 wages for the year, and
maximum credit $5,000.
That's right,
bucks
per
right?
employee. That's right for 2020. And then Shannon, you want to?
Yeah. So in 2021, right? 2021, they increased it to 70% of 10,000 wages per quarter instead of per year. And initially, the bill was all 4 quarters. You could qualify for all 4 quarters, right? So that would have initially been a $28,000 potential credit, but obviously they repealed the 4th quarter, so now it's down to $21,000. So the maximum overall credit could be $26,000.
That's right. And when determining those wages per employee, if the employer covers, if an employee only made $8,000 in a quarter of 2021 or in the year of 2020. If the employer covered some health insurance cost on behalf of the employee, that can be added to the wages to hopefully reach the maximum amount of wages.
So you can add employer-provided benefits,
health insurance, and other costs, Shannon.
Yeah, their health insurance, bonuses, commissions, those things could be included in there as well. And there is a portion which a lot of companies aren't really qualified for, but there was a family leave portion of this where if you had to pay an employee who was either home because of COVID or if you had because of school shutdowns, if you had to stay at home to take care of for homeschooling purposes, there is a portion of that credit that could qualify. Those hours and those wages that were spent, because of government mandates where you're at home or if you were recovering from COVID. So,
yeah. So I think one of the key takeaways you mentioned a minute ago. So you're working on a 3-year statute, right?
That's right.
You don't need to get concerned if you haven't.
That's right.
If we haven't called you yet and say, hey, we're looking at your ERC or we've got some folks you need to talk to.
Right.
You've got till the rest of this year and all of 2023.
That's right.
And part of 2024 for that 2020
credit. That's right.
And then on
another
into
year.
25
That's
it's just by quarter.
Mm-hmm.
Okay.
Yeah, so just like we've said a few times, there have been some changes, from when it first came out in March of 2020. One of those ways was originally, a lot of people ignored this retention credit because the CARES Act said that you could not take advantage of the PPP loans and the retention credit. And so, as we all know, most people took advantage, had a PPP
So you couldn't
loan.
use those same wages.
Well, back then you could not take advantage of both. And then they changed that, I think later that year in the Consolidated Appropriations Act. And said you could, but like you're saying, you cannot use
in the
same
forgiveness
wages.
Right. You
right.
can't use the same
That's
wages.
Right. So, so when we're looking at the credit, and Shannon, I'm sure y'all do the same thing. You look at the PPP loan forgiveness application to see what wages were used for the forgiveness, and those wages cannot be used for the retention credit calculation. So there's some calculations that go on based on that, and goodness, there's lots of IRS guidance on how to determine which of those wages were used for PPP. But hey, at least we have some guidance, I guess.
Right.
What other changes have you seen in the different iterations of it?
Well, there was a recovery credit added to it for startup businesses that would qualify a startup business that started its operations on or after February 15th of 2020. This was a $50,000 per quarter cap on a credit. Reason the Congress passed this, or the iteration came about, is because a lot of the testing was done because of 2019 revenues, and
Yep.
so if you're a new business that you didn't really have anything to compare it to from a quarterly perspective in 2019. But again, unfortunately, with the repeal of the fourth quarter, that only left the startup recovery to a $50,000 maximum, which would be for the third quarter. Now, you can, as a startup, qualify for the credit just in the general terms that we talked about, as far as like mandates and things are concerned. But this was kind of just a minimal qualification factor, just saying, look, if you were a startup, this is accessible to you, because we actually have seen startups that have, you have to be under $1 million in gross revenue to be able to qualify for the startup. But we've actually found 45 employee clients that started in 1 year, and they were able to qualify for a larger credit based on the mandate portion of it, and not have to qualify for the startup portion of it. So that's one of the iterations. That's really the only major change that's happened since the last iteration of the bill.
Okay.
And I think we've talked about the PPP wages.
Yep.
Yep.
Yeah. So, excuse me. These numbers can be really large. If you've got a lot of employees and you meet the test.
That's right.
I mean, we've seen some really large numbers.
Yes,
in our shop.
That's right.
And I know, Shannon, y'all have seen some tremendous amounts of credits that are coming back to people.
Yeah, we've seen, what we're seeing on average. I'm not sure what your averages are, but mainly on the testing from the business disruption portion, we're seeing averages of maybe $14,000 to $16,000 per employee. In some cases, because obviously a lot of businesses are not going to qualify for every quarter, because a lot of states started opening up and mandates started getting relaxed, right, especially the later you get into 2021.
That's right.
But that's still a significant amount of money. I mean, imagine having 100 employees and being able to receive a $16,000 credit per employee, right?
Yeah.
It's a tremendous amount of money. So, and the IRS is going to scrutinize things that are above $1 million a little bit more. They just kind of announced that, where before I think it was just, hey, we're going to write checks. They've decided if it's $1 million credit or more, they are going to review documentation and things as well, which, some people would consider that, oh no. But to me, it's actually a helpful thing, because, if there ever is a review down the road of this credit and the IRS has already taken a look at it, you're less likely to have any issues there right down the road. So, but the unfortunate thing is, we're still having to wait 6 to 9 months to get checks out of the IRS right now for these
that's
payments.
What I was going to say. Once we file those 941X forms to claim the credit for each quarter, we are seeing, that it does take several months. So currently, y'all are still seeing 6 to 9 months. We
have seen that. The fortunate thing is there are some funding options available out there. We have seen that. So there are companies out there that we have been able to refer to for businesses that really need the upfront, the cash right now. That there are some companies who've stood up banks and VC firms that have started to pre-fund these things a little bit.
Okay.
So in the event that a company is, and the great part about this is really helping boost a lot of these businesses that were in real need. But the unfortunate problem is when you don't get paid for 9 months, it really doesn't help much.
That's right.
But there are options out there for people that do need funding.
You mentioned it somewhat earlier, Shannon. There are a lot of people out there selling this service to a lot of people. I hear it on the radio all the time.
Oh, yes. Our clients hear it on the radio all the time.
Right. So we would prefer they use reputable people like us and y'all.
That's right.
Right.
To help them. So how do we differentiate ourselves between those?
I think so. No, it's a great question. And actually, I just had a conversation about an hour ago with the new partner we're bringing on. The sad part about this is most of these pop-up shops will not be here next year. They're going to get paid. The IRS is going to pay them. They're going to get their fees, and a lot of these ERC, consultants have never been in the tax credit space before.
Yep.
So we're actually unfortunately seeing a lot of mistakes being made. We've actually had to go back and review some clients' work that have come to us and said, hey, Shannon, this doesn't look right. I don't feel right about this. My CPA doesn't feel right about this. And in the review, we found out they were either overqualified for quarters or underqualified. We just had an example of a client who came to us who only got $100,000 from their ERC shop, and it turns out they were eligible for $800,000. But unfortunately, now we have to file another 941X, which could throw up a red flag, right, in some cases. So the key to this is you really want to look for somebody who's going to have longevity in this industry. The ERC credit is a great credit for these businesses, but there's so many other credits out there. And organizations like ours and yourself that process and file these other credits, this is a great opportunity for everybody, but this isn't how we pay our bills, right? How we pay our bills is with these other credits and being in the business 10, 20 years and the longevity. So to me, that's more importantly than just the background is, are you going to be here next year if the IRS comes calling? Absolutely. If I need to answer questions? I mean, and unfortunately, I think a lot of shops are not going to be.
Yeah, I think you're right. Of course, this is all going to end sometime in 25, right?
That's right. Mm-hmm.
Yeah.
So
it will.
They won't have a phone number where you can call them and say, hey, the IRS is wanting to know about this.
That's right.
But y'all are going to be around. We've been around for 102 years. Y'all have been around not quite that long, but you still do a lot of work in the the WOTC credit, I guess, the work opportunity tax credit, right?
Yeah, we do. We do a lot of work opportunity. We do a lot of empowerment zone. We do disasters for all the hurricanes, floods, and fires. I mean, California's got a lot of wildfires right now, and there's a lot of credits surrounding that, and some state credits as well, job creation and things like that. So, I mean, we're a firm. We're not a stand-up shop. But like you said, you guys, I think it's going to be really important down the road because the IRS, on occasion, is going to review these things even before 2025, right?
Yeah.
They're going to want to come in and review these things, and you're going to need documentation. And mainly, to me, also is important is to look for someone who's going to back you up from an audit perspective. Yes. If it did happen, someone who's willing to say, we will refund any penalties, any interest, any fees that could be associated with this if we make a mistake. Now, knock on wood, we've been doing this over 20 years and never had one overturned by the IRS. But if it ever did happen, we would 100% refund any penalties, interest, and fees, and anything associated with that. And I think that's something important to look for as well in the vendor.
Absolutely.
I agree.
Absolutely.
Kristi, any other questions, comments?
I don't think so. We appreciate.
Have we kind of covered everything on ERC credits?
I think we have. Yeah, absolutely. I mean, I wish it was as easy, to process as a 15-minute conversation,
right.
But we could do the best we can of explaining it, but unfortunately behind the scenes, that's where things get really, can complex. And that's why it's important to use, firms like yourself and groups like us so that we can navigate that muddy water for you.
That's right.
Yeah.
We're going to continue conversations with our clients and be putting them in touch with you guys and getting them started on, I know y'all have sort of an entry questionnaire that helps get started with the determination. And so we're set up.
I just sent one of our revenue test templates out to somebody today, so and I don't know if they'll make the revenue test, but they certainly might.
That's right. Yeah.
Need the
we at least look at the revenues first because those are no-brainers. But but then then we'll be giving you guys a ring.
Yeah. Well, that's big money. I mean, and if you're a JMF client, you hadn't heard from us yet, don't think we're not thinking about you or working on it. You'll hear from us soon. That's right. Yeah, I've got one client right now that I guess their controller knows we're working on it, but haven't mentioned a number. It's that one we were talking about a minute ago, and it could be pretty big. So the owners are going to, at least for a day, think we're pretty good, right?
Those are nice conversations to have.
Shannon, thank you for your... Go ahead.
Absolutely. I was just going to thank you guys. I was just going to thank you guys for having us, and we really appreciate the partnership and the trust that you guys have put in us, and we are looking forward to helping out down the road. So,
boy, we do too. We appreciate you being with us today. Mary Ann, wherever you are, thanks for being with us. This is a topic that we need to be working on. So,
that's right.
If you'd like Jamison Money Farmer to help you connect with OnCentive, help your business in any way, or if you'd like to suggest additional podcast topics, simply send an email to info@jmf.com. And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps. Thank you.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.